Welcome back to The Retirement Key. I'm Casey Biddy, and I'm here with certified financial planner at Abich Financial Services, Joshua Barbin. JB, it is great to see you. How you doing?
Good, Casey. Great. Thanks.
Good.
Nice to see you too.
Good. Well, I'm excited to get into our show today because we're kicking off a two-part series on a topic that I know you're really passionate about, JB, and it's something that sparks a lot of questions and a lot of strong opinions too, and that is Roth conversions. What are they? When should you do one? Is it the right move for you? That's what we're digging into over the next couple of episodes here on the Retirement Key. So let's just start right at the top here, JB, because I think sometimes people hear the term Roth conversion and, they smile, they nod like they understand it. But if they're being honest, they don't really know what it means or what it involves. So break down the basics for us.
Yeah, what is a Roth conversion? It's God's gift to financial planning. No, I'm just kidding. It's a way of moving money from that 401k, IRA, rollover IRA, 457, all those different accounts that you build up savings in over the last 20, 25 years, never paid tax on. Well, the government's going to come and get their, they get their pound of flesh, as they say, at a certain point in time, and that's called an RMD. And so as people approach that age of RMD, they think about, man, maybe this tax time bomb I might be facing, especially when they get a chance to look at it kind of on paper and they see, oh, I've got a social and a pension and I'm going to have to take out this much from my IRA or 401k. And so a Roth conversion is a way of moving money from that 401k bucket into a tax-free forever bucket. So it's a really powerful tool. There are times that it can be used and times when it's not best to be used. So it's kind of a delicate situation. You really got to understand your personal tax situation. But to hit the high level, it's moving money from a bucket that is going to be taxed, required to be taxed, to a bucket that is not ever going to be taxed again. And that's the high level of what it is.
Got it. All right. Well, so now that we've got the definition down, the next logical question is the why, which you kind of touched on, that tax-free. Why would somebody actually want to go through the process of converting money from a traditional retirement account into a Roth?
A couple of reasons, Casey. Number one, and the most basic, is that a Roth conversion on some level is a gamble. So it's a bet on future taxes. Now, could taxes in the future be lower? Yes, they could be. Nobody knows the direction of taxes, but could we take a guess? Yeah, because the United States government, I think everybody knows this some way or another. It's pretty popular that the United States government spends a lot of money. We all know that. And how do they float those bills? Well, they float it by personal income tax. The biggest source of their revenue is your tax dollars. And retirees should have a target painted on the back of their t-shirts, like anywhere they walk around, because that's the easiest place almost to collect from, is people who have made big money. And it's sad too, because these people have been responsible and savers, and then the United States government could simply say, what, we're raising the tax rate from 24% to 32%. 8% more of your money now belongs to the government, right? So 24% is sort of the middle of the tax bracket, right? And a lot of our clients find themselves, the tax bracket works like this, Casey. I don't want to bore people. I know taxes is the most riveting topic, but you basically have two big jumps in the tax bracket. You have 10, 12, and then it goes to 22. There's your first big jump. 22, 24, and then it jumps to 32. So there's your two big jumps from 12 to 22, 24 to 32. Ideally, you don't want to make those jumps. So what a Roth conversion is, like really getting down in the weeds, is converting monies in those buckets below 24% usually is what you want to do.
Well, that makes sense. The idea of getting ahead of future tax increases and setting yourself up for more flexibility in your retirement. But now I've also heard some people say, I make too much to contribute to a Roth. So let's clear that up too, JB. Can anyone do a Roth conversion, or are there income limits or restrictions that people need to be aware of?
Yeah, this is where we're talking about that level of 24 for a lot of people. It depends if you're an ultra high earner, then this might not apply to you. But if you're kind of our typical retiree in America, and let's say you're still working, it's important just to understand how the taxes work in America, income taxes. They're kind of like buckets, Casey. So you fill up one bucket, the 10, then your next amount of money's at 12. You pay 12 on the next amount. You pay 22 on the next amount, 24 on the next amount. So the idea, let's say you're earning at 12, you're $100,000 of wages, and you want to do maybe some Roth conversions. Then you're going to do your conversions. Anytime you take money out of an IRA or 401k, it's going to be income. And so that's going to be taxed at whatever bucket you're at. And that's where Roth planning comes into play because, yeah, everybody wants to have tax-free money. Everybody. But the fact is that does it make sense for you to do it right now? Does it make sense to do after you retire? While you're working, after you retire? Should you contribute to a Roth? I mean, there's a lot of questions around getting money into these tax-free buckets, and sometimes it truly isn't the right time. If you're going to earn less later on, sometimes it makes sense to wait a year or two till you're done working. In some of our clients' cases, let's wait a year or two till you actually retire, and then we have a great opportunity for the next 5-7 years, really do some Roth converting.
It's all about the timing, and you got to be strategic. Now, here's where I think it gets tricky for a lot of people, because when you hear the word tax-free associated with a Roth, it's easy to forget that the conversion part might be taxable. So what should people understand about the tax implications of doing a Roth conversion, and how do folks typically cover that tax bill when it comes due for them?
That's a great question, and there's one of two ways to cover the tax bill. If you've got a bank account with a whole bunch of money in it, which some people do and some people don't, but those who do have a bank account with a big pot of money there that you've been earning good interest on, and you want to do a Roth conversion, you can pay to move money from the IRA to the Roth IRA with the bank cash. You can pay next April. The other way that you can do it is if you pay from the actual IRA account. So, you've got $100,000 in the IRA, you move it to the Roth IRA, but before it goes to the Roth bucket, you're going to pay 20%, let's just say. Now you're at $80,000 in the Roth bucket. The best case scenario is that you could move the full $100,000 and pay the taxes, that $20,000, from somewhere else. Because then you went from a taxable bucket to a tax-free bucket without losing any value. Now, you can't always accomplish the ideal. Even the non-ideal, in many cases, can make significant difference over the long term.
Got it. All right. Well, before I let you go, JB, I know the tax landscape, it's constantly changing, whether it's new legislation or projections that taxes could rise in the future. A lot of people are trying to be proactive now in their planning. So how are those changes, both the current changes and expected changes, influencing the way people are thinking about Roth conversions right now?
Yeah, so we just got with a big, beautiful bill. The rates that we've had since 2017, Casey, have now become permanent. So they're enshrined into law. So these rates, they can seem high. Like when you get a tax bill or your paycheck and you're paying 24 or even 32% in some cases, it could seem like a lot. And yes, it's true. But when you consider the highest bracket is 37, let's say you're making $2 million a year, you're going to pay top bracket 37%. That bracket at times in American history has been 90%. And not even like way back when, I'm talking like in the 70s. It was still up in the 60s, 70s%. So the idea of paying taxes now at 25%, though, it can hurt a little bit. It's better than 50% or 40%. So the idea of taking advantage of these Trump tax cuts that were put in 17 and now we still have, gives you the opportunity to pay your taxes at these 10, 12, 22, 24% brackets. Take advantage of some of these really great rates that we still have available so that you don't get bit by an irresponsible government in the future that just so happens to need to raise a lot of money and you look like a great target to do so. So I think the better play is to at least consider, should I have a tax-free bucket working for me, Casey? And then one more thing, they've changed the rules so much on RMDs over the last few years. We had Secure Act 1 and Secure Act 2. I won't go into the whole boring thing, but the big thing that you can see there is that they can change the rules. And what matters then is getting it done before they change the game. Getting your tax-free bucket set up before the rules change again and they make you take out more, they make you take it faster, or they raise the taxes. Setting up a tax-free bucket for you and, Casey, of course, your kids. The Roth bucket's going to be tax-free not only for you, but they're not going to be able to collect when you pass your money on to your kids. And that's the beautiful thing about the Roth bucket, especially for those who are trying to pass money to kids.
It sure is. JB, thank you so much for breaking down this intro to Roth conversions for us today. If you're listening and this conversation got your wheels turning and you're wondering whether a Roth conversion might make sense for your situation, now is a perfect time to talk it through with a professional. You can head to theretirementkey.com, and from there you can find all the resources that you need to get connected with JB and the rest of the amazing team at Abich Financial Services. And don't forget, this was just part 1. You don't want to miss part 2 coming soon, where Justin Doback will walk us through when to convert, how to do it in steps, and some of the biggest mistakes to avoid. Thank you so much for listening to The Retirement Key, and we will see you next time.